What's up, apes? Hope everybody has been having a phenomenal week so far. You know, we're doing pretty well over here at the 𝗪𝗲𝗀𝗀𝗀 global headquarters. Things have been pretty good today. You know, nothing too crazy, nothing to be too excited about, except, you know, for the fact that the S&P 500 has officially closed at all-time highs once again. Get the party started here. S&P 5,000 wasn't nearly enough. I gotta throw that hat away and go get my S&P $10,000 hat, because that's how much the hat probably should cost as well, because it seems like that's how much money everybody has with markets just continuously ripping so much. And shout out to Fed Chair Jerome Powell for the boost here. If you didn't know any better, you'd think that Fed money printer Powell was back on deck, but turns out we didn't even need that to reach all-time highs yesterday. Yes, apes, that's right. The S&P 500 is officially higher than it ever has been, and it actually closed at that level, which means it's an actual real high rather than an intraday one, which is, you know, usually just some nonsense. But all right, let's go ahead and get into things here, because we are fired up on this Wednesday evening. It is currently 9:26 p.m. on this beautiful March 20th, 2024. We are coming at you live from the 𝗪𝗲𝗀𝗀𝗀𝗀 global headquarters. Not that you'll be watching this live, but I am recording this live nonetheless. You're probably watching this on March 21st, and we have a lot to talk about to get you set for markets here this morning, so let's go ahead and dive right in. First and foremost, of course, we got to start off with the market snapshot. Pretty good day for the WSO Alpha portfolio overall, rising up 1.2%. Now, pretty much everything on planet Earth had a good day yesterday. I mean, you might not have, and RIP to you for that, but the NASDAQ rose about 1.25%, but we did manage to outperform the S&P 500. Can you guys believe that? We outperformed the S&P 500 on the very same day that it reached an all-time high. That means we're basically the next Jim Simons and Warren Buffett's combined, at least if you ask me. So get in while the getting's hot. We're also officially coming out with our Tesla research report tomorrow, or I guess it's later today now. So that's going to be dropping later on today. Everybody go check that out. We got quite the bold take on Tesla. You're definitely going to want to see it. Most of all, you're going to want to see our revenue projection, because it's definitely some stuff that a lot of you are going to have some very strong thoughts on, and personally, I can't wait to see what they are. But outside of the Alpha portfolio, like we said, it was a pretty good day for U.S. markets broadly. Bitcoin prices, we'll be talking about those in just a quick second, so I'm not going to step on our content just yet. So what we're going to do is go ahead and move into some of the banana bits for the day. So first and foremost, this link right here, guys, if there has ever been a link in the banana bits in any daily PL that you're going to click on, this is the one to do it with, because this is one of the best charts that I've seen in response to the FOMC's meeting yesterday, and that is showcasing the change in dot plot projections from the December meeting to the meeting that just happened or just wrapped up yesterday. Basically shows the drastic change in kind of expecting rates to be, much different. So go ahead and click on that, because the rate picture has changed quite a bit. Not necessarily that they moved lower, but it's still very good news nonetheless. So please feel free to go ahead and check that out. Now, guys, Reddit is also IPOing today. I mean, this is a huge news day. Who knew that Thursday, March 21st, actually the spring solstice, equinox, whatever word is used for that. So it's the spring equinox here, and there's a shit ton of news coming out of Wall Street at the same time. So the Reddit IPO is going on. I know a ton of you are probably on Reddit as well. Maybe some of you are even one of the lucky 75,000 shareholders that Reddit issued shares to prior to actually going public, so you can get in on the gains with the venture capitalists and the other scumbags that take advantage of the price action of selling to idiots like you and me in the public markets. All right, Micron, they also reported earnings yesterday. I know the news simply just does not stop. This is a semiconductor company, and they are keeping the AI wave rolling here with their Q4 earnings. They were up 14% after hours by the time I'm writing this, so we're going to want to be monitoring that stock tomorrow. Probably lift the entirety of the market, and we'll probably be setting even more all-time highs, so definitely stay tuned for that. And finally, Mr. Julian Assange. You guys might have heard of this little cat before. He is the founder of WikiLeaks. He's been, between pretty much everywhere all over the world. I don't think anybody really knows where he is or has been, but he has been on the lam from the United States prosecutors for quite a while. He's coming close to a plea deal with them to plead guilty, get 14 years. It's a hell of a lot better than the multiple centuries that he probably would have gotten originally. So maybe being on the lam for this long was a great way to kind of trade down that sentence. But either way, it looks like that saga might be coming to an end. Obviously something that a lot of you are going to want to pay attention to. Alright guys, let's go ahead and get into the big story of the day. Not only the big story of the day, the big story of the week, the month, the year, and that is Jay Powell speaks. We had the March FOMC meeting. This is one of the most anticipated FOMC meetings that, quite honestly, we've ever had, since these events have quite literally become on par with the Super Bowl in terms of how much money is going into these things and how much is being paid attention to. This was an absolutely huge event, and I mean, I just want to continue to pledge my allegiance to the Jerome Powell States of America personally, because that's what it seems like here. Pretty much just got to trade alongside the Fed, basically. What happened yesterday at the FOMC meeting? So Jerome Powell stood on stage at 2 p.m. and announced that rates were going to be held at the exact same level that they're currently at, in that 5.25 to 5.5% range. Absolutely nobody on earth was expecting this back in about September, but by yesterday or by the days prior, that was the leading expectation. Pretty much everybody knew that that was going to happen, and that's exactly what happened yesterday, but it still drove markets higher. So obviously the question becomes why? If exactly what we expected happened, why would this change equity prices whatsoever? So it's pretty much everything else that came with this report. The fun thing about the March Federal Reserve reports is that it comes with a summary of economic projections. This is a quarterly report that the Fed provides that's going to be telling us exactly what they're thinking about the economy going forward. So although rates were held relatively the same, it's the view on rates going into the future that's going to be changing. Now, if we look at the Fed statement tracker compared to the January 31st meeting to the meeting that just happened yesterday, this is the least amount of change in any Fed statement that I have ever seen. Now, don't get me wrong, I'm 24 years old, so I haven't really seen anything whatsoever. But what we can see is that 6 words were removed and only 2 letters were added. So it went from being job gains have moderated since early last year but remain strong to just job gains have remained strong. And that's literally the only change in the entire statement. Everything else is exactly the same. So once again, nothing really changed. Why the fuck are markets going higher? Let's go ahead and dive right in. Really, the big reason is because if it ain't broke, don't fix it. Things have been going well in the U.S. economy despite recent upticks in inflation and recent less than ideal hiring numbers that we've seen in the January and February jobs reports. But 𝗪𝗲𝗃, the guy, has balls of steel. He's our fearless leader, and he didn't give a damn. He shrugged it right off and said, we don't care about that whatsoever. And that's largely what led to a lot of the changes in these projections here. So the biggest and most notable projection change was in GDP growth for 2024. Prior to this, back in December, the last time the summary of economic projections came out, everybody was expecting GDP growth in 2024 to be somewhere in the range of about 1.1, 1.2% to about 1.8, 1.9%. And now the vast majority of expectations are for that to be about 2% to right about 2.5%. That is a huge difference when we're talking about a $27 trillion economy being the size of the United States. That's going to have huge impacts on the S&P 500 earnings if that actually does come into fruition. That means that EPS guidance and all that different kind of stuff is going to be rising so much. We all know what happens when EPS expectations rise. Stock market to the moon, and that's exactly what happened yesterday. So we're pretty fired up about it, but it got even better when we went ahead and took a look at employment expectations. We can see that unemployment expectations were falling at the same time. And guys, what happens when expectations for unemployment are reducing and GDP growth is increasing? That means one thing: there's going to be less of a need for rate cuts going forward. Now, less of a need for rate cuts, that might not sound like a good thing, but let me explain a little bit here. So rate cuts are only good in terms of their discount quality of U.S. equities. So these interest rates, they kind of serve as the benchmark for discount rates that are applied to stocks. So obviously when it's increasing, that's going to very much reduce the value of the stock prices in their current form, because the value of those future earnings are going to be a lot less compared to what they otherwise would be if the discount rate was a little bit lower. So when we're lowering the effective federal funds rate, we're also lowering the discount rate that gets applied to U.S. equities, and that's why stocks go up in the meantime. But if we're lowering interest rates for the broader economy, for the real world, for what your mom and dad are out here doing, for people with actual brains that go out and contribute to society, personally can never be me, but what that means for them is that the economy is just doing so well that there's no need to cut rates. We don't need to give that extra liquidity and juice things at all. So it's actually a very good sign if they're not cutting rates, and that's why this is very much a Goldilocks report. We can see in the dot plot that economists, all the participants at the FOMC are starting to become a little bit more centralized in kind of what their view is on rates going forward. Everybody and their mother expects rates to be in the range of about 4.5 to 4.75% by the end of 2024. That basically implies 3 cuts, or 325 basis point cuts to the federal funds rate by the end of the year. Obviously, we'll see if that actually comes to fruition, but over the past couple of weeks, that kind of started to form into maybe there will only be 2 cuts, and people are getting a little bit scared that there wouldn't be that much. So this is going to be a short-term boost to overall equity markets, but the fact that we do have to cut just kind of speaks to the fact that, 1, economic growth might be slowing, 2, maybe we were too restrictive, but that was needed to kind of reduce inflation without damaging hiring too much. That was one of the biggest things that 𝗪𝗲𝗃 emphasized in his speech here today. So we talked about the numbers, but let's get into the words, because realistically, that's what matters. I mean, hedge funds have been built on the tone of voice that the chairman of the Federal Reserve uses in his speeches, in these press conferences. So let's go ahead and see what the guy had to say. We've included 4 quotes in here that are kind of our biggest takeaways from yesterday. First and foremost, he's talking about how policy rate is at the top of the cycle, is really not going any higher. The only question is, when and by how much is it going to go lower? Secondly, he said, we don't know if this is a bump in the road. He was referring to recent upticks in inflation and recent kind of hiring numbers coming in a little bit weaker than expected. Said, we don't know if this is a bump in the road or something more. We'll have to find out. We're not going to overreact to these 2 months of data, nor are we going to ignore it. That's exactly what you want to hear a Fed chair say. He says, we're not going to get too spicy, we're not too antsy, just because we got a couple of months that aren't doing too well. Imagine if the Celtics were leading by like 20 points in a game, and then all of a sudden, you know, whoever they were playing against, the Knicks or whatever bum-ass team you want to put them up against, say they hit 3 threes in a row, you know, they're still up 9 points. They're not going to get too upset at that point, but obviously you start to pay attention to it, you get a little bit nervous, maybe you start to play tighter perimeter defense, and that's essentially what 𝗪𝗪𝗪 is saying right here. Then on the recent upticks in inflation, he had further to say it hasn't really changed the overall story. Inflation is continuing to move back in that direction of 2%. And the best part is that he said on a sometimes bumpy road toward 2%. So that shows that the Fed is pricing this in, for lack of a better term. They're expecting there to be challenges on the way to 2%. So once again, reiterating the fact that they're not going to be overreacting to upticks in inflation like this. Then, of course, on slower hiring, he also said this could also be a reason for us to begin the process of reducing rates. That got the apes fired up from Wall Street to Silicon Valley to fucking Beijing, if you ask me. Everybody was fired up because he was basically saying that if hiring continues to slow, that's going to be a reason to cut rates, free up that liquidity for companies so that they can use that to go and spend more on hiring employees. That's kind of the very gross, simplified way of how it actually works. And obviously that got everybody fired up because not only do rates go lower, rates going lower is going to reduce the discount factor that's reducing the price of equities, but that's going to get more people employed. That means more money in consumers' pockets, and that means more consumer spending, which once again means higher earnings for these S&P 500 companies. It's all going well. We really can't find a bad thing to say about this report here. So let's just go ahead and move into some of the stock movers of the day. So first and foremost, what's right? We have Mr. Mobileye. This is one of those autonomous vehicle companies that everybody kind of forgets about because they're basically owned entirely by Intel. And Intel has been like the embarrassing, annoying older brother of the semiconductor industry. It's like the guy who, moved out of the house first, but then quickly became homeless. And now he has a dog and he's like, just has no idea what to do with it. All right, I'm going to stop rambling on that. But basically, Mobileye is the often forgotten about autonomous vehicle company, but they had a huge deal with Volkswagen yesterday that said, you will not forget about us that easily. Basically, Volkswagen expanded a contract with Mobileye to start using the company's technology in more and more of their vehicles. Everybody got fired up, not necessarily because of the dollar amount, but more so because of a proof of concept of Mobileye's technology. Shows that they must be doing something right. Then, of course, Chipotle Mexican Grill up 3.5%, just about, reaching an all-time high yesterday alongside markets. Basically, Wall Street heard that my younger brother was actually considering becoming a manager at a local Chipotle spot back up in Massachusetts, and so obviously markets had to rip. Or, it could have been something to do with the 50-to-1 stock split that the company announced yesterday. This is the first stock split in Chipotle's history, and it's one of the largest in the history of the New York Stock Exchange. When I say 50-to-1 stock split, what the hell does that mean? So Chipotle, basically, I could pull up the number, but for mathematical purposes, let's just go ahead and pretend I know what I'm talking about. Let's say that Chipotle is trading at about $1,000 per share. They do a 50-to-1 stock split and you have one share. That basically means that you are now going to be owning 50 shares at $20 a share. So you still have the same notional value. It's still that $1,000 value, but they're dramatically changing exactly how that works. So they're going to be increasing shares outstanding by about 50x, reducing the price of those shares by 50x at the same time. And that doesn't really do anything to the company whatsoever. But everybody gets fired up about these stock splits because it makes it a lot easier for retail traders like you and me who are absolutely broke and just doing whatever the fuck they can to try to not be homeless for yet another day. This makes it a lot easier for those retail traders to start to buy in and actually hold the stock in their portfolio. Obviously, everybody that goes to Chipotle, the place is a goddamn cult, so everybody loves to buy that shit. I'm sure their biggest fans would love to buy it too, but probably not for the $3,000+ share price that it's been trading at. All right, then we got Signet Jewelers. Guys, diamonds might be a girl best friend, but losses are an ape's absolute enemy. So Signet Jewelers didn't really get the message yesterday. The stock was down over 12% because nobody's falling in love anymore. Everybody hates each other. Nobody's getting married, proposing, or having sex, as we talk about all the time as well. I mean, certainly not me, of course. But basically what happened yesterday was Signet Jewelers, one of the biggest jewelers in the United States, came out with a recent earnings report. They basically missed on both the top and the bottom line. They gave absolute garbage guidance. But they did boost dividends by 26% to try to save the day. Didn't work at all. Nobody cared whatsoever. Neither do we. So let's go ahead and move on to the final stock mover of the day. Here we have BioNTech. This is the company that at one point thought they were a hero. They teamed up with Pfizer and saved the world from lockdowns and the COVID-19 virus. But It turns out in their Q4 earnings report, I'm sorry, I'm laughing after seeing this number right here, but revenue fell at 66% in the final quarter of this year compared to the year prior, and 2022 was a decline from 2021 anyway. They went from making well over $18.3 billion in 2021 to making exactly $3.8 billion in 2023, excuse me. That was the total amount of revenue that they took in. They used to be breaking in quadruple that in just COVID vaccine sales alone. Obviously, nobody's buying the COVID vaccine anymore because governments aren't literally mandating it, and colleges and universities, other employers aren't literally mandating it for their students, employees, and other unfortunate participants to be involved in that situation. But obviously, it's going to be a tough scene for this company. Now, the good thing that they do have going for them is they have this reputational addition from saving the entire world. So obviously, everybody knows that one, their technology is good. Two, they're, I guess, good people trying to, vaccinate the world. But, it was definitely a tough day, down about 4.5% for them. We'll see if they can recover going forward. Finally, the thought banana of the day. We kept this one nice and short and sweet for everybody because this might be one of the longest daily peels of all time, given how much rambling and yapping I did about the FOMC meeting. But we had to talk about Bitcoin prices as well. This thing has been absolutely plummeting in recent days, and not necessarily a big reason for it, but alongside that fall has been an absolute plummet in inflows into Bitcoin spot ETFs. Yesterday, Tuesday, so actually yesterday for me right now, and 2 days ago for you watching this right now, on Tuesday, March 19th, this is the single largest day of outflows for the spot Bitcoin ETFs that they've had in their entire history. Now, don't get me wrong, they showed about 11.67 billion in net inflows if we exclude GPTC. And a large reason for these outflows was simply just the falling Bitcoin price. So what we're kind of seeing right now is a big dichotomy between hodlers, with diamond hands and hodlers with paper hands. As Jim Bianco points out, he's the guy who I stole a lot of these charts from for the peel tomorrow. As he points out, the spot price that a lot of these purchases were made was basically $57.5 thousand or $57,500 if we include GBTC. But if we exclude GBTC, the average purchase price is sitting at $57.1 thousand or $57,100. Excuse me. And so basically, once the price falls below those levels, those funds on average are going to be trading at a loss. And if they're trading at a loss, we know that a lot of these paper hands, TradFi, boomer-ass grandfather people, they are not going to want to sit around while they're just losing on their Bitcoin investment. So they're going to be dumping even more. That's going to lead to even more losses. But luckily, Bitcoin, of course, has the halving coming up in April. We'll see if that can actually move prices like it's done in the past, because historically, this is kind of an exponential move, and that's why we included this logarithmic chart below to really encompass those exponential changes that occur with Bitcoin price action. So we'll see what happens in April when the halving occurs once again, but for right now, it's been a tough week for Bitcoin bulls, but you guys can all shut the fuck up because the thing is absolutely ripped still over the past year or so. I mean, unless you bought at the previous peak, I certainly don't feel bad for you. All right, and that about does it for us here today. We're kind of just wondering going forward how TradFi investors are going to respond to the volatility of Bitcoin. Maybe if the enormous liquidity of places like BlackRock, Fidelity, and other providers like that can, bring some stability to the price action in this market. Like I said, that about does it for us here today. The quote of the day, Mr. 𝗪𝗲𝗀𝗪. Of course, don't fight the Fed. He is the father of one of the greatest financial writers I've seen of all time. He is himself one of the greatest financial writers of all time, but he was back in like the 1970s. I'm pretty sure that's before newspapers even existed, because, what could have possibly existed back then. But his son, Jason Zweig, is one of my personal favorite financial writers. Definitely go check out his stuff. He said, don't fight the Fed. There really isn't a better message out there. That's like saying go through life by fighting God or fighting your parents every step of the way. You don't want to fight the Fed. They are setting the rules, and you are playing the game. Obviously, we don't want to go against their rules. That about does it for us here today. I know this was a pretty long and intense one here, but, we got fired up. We're at all-time highs. S&P 500 is absolutely killing it, just like JPOW. Even my portfolio managed to be up for the day, and obviously we know that never, ever happens. Thank you guys for hanging with us to peel things back here. It is now 9:44 p.m., and I'm going to go eat one of these bananas just to finish off the full peel here for the day. So I'll see you guys tomorrow. Obviously, happy investing, happy trading, all that nonsense. Bye.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. Until next time.